Hello, everybody. Hello, hello, hello. Happy Wednesday. Appreciate all you being here. Hello, Gene. That was quick. Thank you so much for letting me know. I always ask that. Make sure everybody can hear and see me okay. So, how about anybody else besides Gene? Hoping so. I know there's a bunch of people here right now. Hopefully, that is the case. And I want to dive right into something that I pre-typed. Good. Love that. Love that. Who else is in here? Come on, come on, come on. There we go. Thank you, Dave. Thanks. All right. Before we hop right into the topic of the day, which is synthetics, just want to let everybody know tomorrow is a huge eco data day in the market. In the morning, we get the normal weekly jobless claims. We also get retail sales. We get producer price index. We get CPI earlier in the week. We get PPI tomorrow. And then there's Empire State Manufacturing. That's the New York area. There's Philadelphia Fed Manufacturing. Obviously, that's the Philly area. And then Powell speaks. So tomorrow, we could see some volatility in the marketplace because there is a lot of eco data happening tomorrow. All right. No market mind link in the OptVol room. I'm not sure that is accurate, Robert. I know I posted one up here. And in fact, if you look at 1053, there it is. I will be happy to put it in there again. As you can see, I'm doing live. There it is again for everybody. Everybody get that? Well, if you're here, you obviously got it. So before we get going here, guys, come on. Come on. Subscribe. Smash that like button. All right. Well, Robert, the notifications already went out on push as well, man. Okay. But anyway, let's talk about synthetics. Okay. Now, what are synthetics? Synthetics are man-made materials created from chemical compounds, and they're used in place of natural materials. Okay? Who cares? Why is that relevant? Who really cares about synthetics, at least for trading? Right? Who really cares? Well, what about synthetic options? Now we are talking. So just like a synthetic item, a synthetic ingredient, right, is something that replicates something else, it's no different when it comes to talking about options. We can replicate a position synthetically without having that real position. Now, I'm sure you're all probably completely confused right now and saying, what the heck is he talking about? Hello, Troy. But let's go through it. Okay. So what are synthetics? Synthetics are a way to artificially create a financial position using a different strategy. And when you have a synthetic position on, it duplicates, it recreates both the reward and the risk of a different position. And that is when you are combining stock and options. And that reward and risk is not only from a dollar profit and loss perspective, it's also the Greeks. It's also your delta and your vega and your theta and all that good stuff. Okay? And the way or the reason why synthetics work is because of the concept of put-call parity. What is put-call parity? We talk about it often, right? Put-call parity means that the amount of premium or the amount of extrinsic value that is in the price of a call option has to be the same as it is in the price of a put option with the same expiration, same strike. Okay. Now, there's always exceptions. And an exception in this instance, twofold that I could think of would be one, if a stock pays a dividend, and two, if a stock is hard to borrow. But if we're looking at typically, 99% of the stocks that we're, trading, we will absolutely see put call parity. Okay. Again, what is that? That is the amount of premium, the amount of extrinsic value that is priced into a call has to be the same as is priced into that put option, same strike, same expiration. Does that make sense to everybody? Awesome. And we're going to go through some examples. We will definitely go through some examples here. Okay, everybody with me? Wonderful. Okay, so I'm going to break this down in a different way, but to start, okay, if you wanted to buy stock, you just want to buy 100 shares of your favorite stock, you can do that. No issues, obviously. You can also create that position, though, by buying a call and selling a put. Same strike, same expiration. That will give you the exact same property as being long 100 shares of stock, buying one call, selling one put. Okay. Now, from this algebraic equation, and I always like to break everything down to math. Okay. From that algebraic equation, we can then create a long call position. So a long call position can be replicated instead of just buying a call. Okay, you can buy the stock and buy a put. That replicates from a reward to risk and from a Greek standpoint, owning a long call. And algebraically, once again, you can create a long put position by owning a call and being short the stock. Okay. These two positions here, the long call and the long put, synthetically are just variations, deviations from this equation up top. Okay. Now you're probably thinking, all right, thanks a lot. I could probably find this on YouTube, on the internet. Why does it matter? Why do I care? Why is this relevant? Right? How many of you are thinking about that right now? Because if I was kind of learning this for the first time, I probably would be. Teach me something that I can really put to use, Scott. Okay. This is going to be a key chart for you. Okay. I will get everybody a link to this Market Minds presentation today. But what this does right here, this breaks down what I just did here into a chart format, adding also in, because I was just referring back on that previous slide to a long position, whether it's long stock, long call, long put. This also adds in if you want to create a short stock position, a short put, or a short call position. Okay. So again, I will, and let me, Danny, I think you're listening in. If you can, I'm going to send you a copy of this. If you can create a bit.ly link to this, that would be just fantastic. And then we can post it up here. Give me a second, everybody. Thank you, thank you, thank you. Okay, synthetics. There we go. Danny, you got it. Okay. All right. Now, if you own stock, okay, if you just have a long stock position, everybody, your P&L is going to look like this, right? Stock goes up, you're going to make money. Stock goes down, you're going to lose money. It's 1-to-1 because it's 100 deltas. right? Does everybody understand that? Dave, a long call and a short put does not replicate a bearish stock move. Let's go back to this. This is what you're saying right here, Dave. Long call and short put. That's not bearish. That's the equivalent to long stock. Do you see that? Yes, thank you, Paul. Can always count on you. Appreciate that. Okay, so Dave, you good to go now? You understand that now? And again, this next chart here, which you'll all get the opportunity. Okay, here is the link, actually. Thank you, Danny. I'm going to post that in the chat here. We'll do it a few more times, guys. But if you want to download this this deck, this Market Minds webinar deck today, okay, there's the link right there. Okay, how does it replicate a bearish stock move? Well, as I said, this was only the long positions here. But then I said on this chart right here, this also adds in the short positions. So if I want to have a short stock position, I can do that by selling a call and buying a put. And that all comes about from this equation up here, guys. You can manipulate that equation algebraically, mathematically, to get any position you want. Does everybody follow that? Does everybody understand that? Okay, no different than if I had an equation of A equals B plus C. You could arrange that algebraic, equation to solve for any of those A, B, or C. Looks like some people are getting filled at lows in 115, 215, excuse me. Right? Okay. Excellent. All right. Now, let's move on here. So back to a synthetic long stock position. If you just own stock, again, your P&L is going to look like this. 1-to-1 on the upside, 1-to-1 on the downside. If you own the synthetic position, which the synthetic position is owning a call and selling or being short a put, it's going to give you the exact same P&L. Okay, a synthetic short stock, same exact thing. If you have a short stock position, you make money as the stock goes down, you lose it as it goes up. If you replicate that by owning a put and selling a call, it will be the exact same representation. If you own a synthetic long call, okay, if you own a synthetic long call, your P&L is going to look like this. Now, this is a comparison just against long stock, right? And we know that if you own stock, you have unlimited downside loss potential, right? But if you own a call, you have unlimited upside potential, okay? But your loss is limited to what you pay for the call. That is no different. That is no different than owning a synthetic long call is owning stock and owning a put. Okay, and I'm going through these graphs for everybody to show you that the P&Ls are exactly the same. And we'll do one live here in a moment. Here's a synthetic short call. If you sell a call, what does your P&L look like? Well, to the downside, you can only make the credit you receive, right? But on the upside, you have unlimited potential loss. Same thing with a synthetic short call, which would be short stock and short a put. And a synthetic long put, okay, if you own a put, you make money when the stock goes down. You're limited on your loss. That's the exact same thing as owning a call and being short the stock. And again, all of these equations, all of these combinations come right back from this right here. You can get to all of those combinations, which are all detailed on this chart right here. Okay, now let's go through an actual example. I pulled this from Taiwan Semi about, I don't know, 20 minutes ago or so. Okay, so let's look at this real closely here, everybody. Hang with me 1 second. I am sorry, this is Schwab Network and they have a fire drill. They have an emergency and I cannot. Okay. All right. So check this out. At the time I pulled this data, TSM was trading 195. So let's focus in right on the 195 call and the 195 put. Okay. Now, if you were to buy 100 shares of Taiwan Semi at 195, okay, you would be long 100 deltas, right? You would be long 100 delta, right? If you buy 100 shares of stock. Buy 200 shares of stock, you're long 200 delta. 500, 5, et cetera, et cetera. Everybody understands that, right? Yes, am I coming through loud? Okay, there we go. Okay, now, what would your cost be if you bought 100 shares of stock? What would your cost be? Yep, 19,500. Okay, so you got to come up with that, or if you're on margin, you know, whatever it is. But your account is going to get dinged 19,500 worth of your margin, or if you're in a cash account, you got to come up with that. Okay, now let's look at the individual prices here and the deltas and the Greeks and the Vega and everything for a synthetic position. How do I create a synthetic long stock position, everybody? We just reviewed it. I'm not going to put it back up on the screen right now. You tell me. How do we create a synthetic long stock position using options? Anybody? What do we have? Okay, short a put. And what else, Darby? Just shorting a put is not a synthetic stock position. That's part of it. There we go, Bill. Right, I have to buy a call and sell a put. Okay, I have to buy a call and sell a put. Excellent. Jake, Darby, there you go. Dave, perfect. Okay, let's look at everything that's on the screen here. The 195 call, and again, yes, I'm looking at the mid-market, but the mid-market on both of these is the exact same because stock was right there. If I pay $4.58 for the call and I sell the put at $4.58, what's my net transaction cost? There you go, Gene. Or excuse me, Greg. Excellent. My net transaction cost to have this position is now a goose egg. It is now 0. Okay? So $19,500 over here, 0 over here. Now, how is that the same? How is that the same? Well, let's look from a delta perspective. We already know that if you bought 100 shares of TSM, you would be long 100 deltas. Well, if I buy that call, I have a positive 50 delta. And if I sell that put, I have another positive 50 delta. Does everybody understand why? And this is just the equation. We can use these numbers in the exact equation here of my long stock, and we're just going to use delta right now, equals my long call minus my short put. Are those equivalent? You better believe it. You better believe it. So however the stock moves in TSM, you are going to have 100 deltas that replicates the stock. If the stock goes down $2 from here, you would have lost $200 on your stock position. If the stock goes down $2 from here, you're going to lose $200 on this option position. Now, from a Vega standpoint, a volatility standpoint, and I think I cut that off up here, but that is Vega right there. Your Vega is 0. It's nothing because you're buying and selling the same option. One's a call, one's a put, but we know that calls and puts have the same volatility risk, the same Vega at the same strike with the same expiration. So there is no volatility risk here. Does everybody understand this so far? Because this can be a very, very confusing concept. It really comes down to the math. The math works. And then if you understand the dynamics behind the math, the Greeks, the dollar and cents, what your margin would cost you owning stock, selling stock. Okay, before we move on, let's get to the word of the day here, folks. We got a lot of people in here. Let's get to the word of the day. Super smash. Smash, smash, smash away. We'll come back and give a reminder for that in a moment. So here is this slide here. This shows the exact same mathematical equations as that previous slide up above. This shows the exact same scenario we just went through, and Taiwan Semi at 195. What I did here was break down each of these positions, a long stock, a long call, and a long put, using these equations. So the long stock, we just went through it. That's long the call, short the put. 100 deltas equals 100 deltas. Okay? Now, if we want a long call position, that equals long stock and long put. Okay? Well, the long call has 50 delta. If you buy the stock, that's 100 delta. If you buy the put, that's going to be a negative 50 delta, gets you to plus 50. 50 equals 50. Everybody see that and understand that? And then the same if we want a long put position. Well, a long put here is negative 50 delta. A long put is equivalent to a long call and short stock. The long call is positive 50 delta. The short stock is negative 100. That equals negative 50 delta. And again, you can go through the math to create the short positions as well. Everybody following this? Thank you, Eric. Now, let's talk about why you would want to do this. Some of the advantages, right? Because it's great that I'm teaching you about synthetics, but unless there's really a benefit, really an advantage for you to do it, who cares? Right? Nice to know, but who cares? The biggest advantage is the one that we just talked about. Lower capital requirements. Lower capital requirements. You can create a stock position, long or short, without having to trade the stock, which significantly reduces capital requirements. It allows you to take a bigger position if you want. I'm not saying that you unnecessarily want to increase your risk, but it allows you to take a bigger position without that margin, without the additional cost headache, capital outlay. Okay, so that's really, this one right here. I'll kind of put a asterisk by that, or a double asterisk, because that is really why synthetics are a great tool to know and use and understand. Now, risk management, hedging. Okay, these strategies allow you to protect existing positions against market downturns, unexpected volatility, without fully exiting the market. And what a lot of people will do is, we all know, or most people know, about covered calls, right? Most people know about covered calls. And what is that? Well, if you have a long stock position and it's going up, or even if it's going down, and you want to hedge it a little bit, you sell a call against it. Right? Does everybody understand covered calls? We've actually gone through that here before. So before I go into why hedging is so important here, if I have a covered call position, everybody, which is owning stock and shorting a call, selling a call, that's part of the equation that we talked about earlier. What kind of synthetic position is this? If I own stock and I've sold a covered call against it, what kind of position is that synthetically? Okay, if you go back, or if we go back to our chart, you'll be able to find it pretty easily. But nope, it's not a long call, Kent, because we're selling a call here. So remember, if we're talking about synthetics, we have three components to a synthetic. We have stock, a call, and a put. The one value that's missing in the equation would be the synthetic part. So because we have stock and a call in this position, that means synthetically it is something about a put, right? Because the put is missing. Put's got to be on the other side of the equation. So is this the equivalent of a long put or a short put? Robert just said short put. Gilbert said short put. Tim, it's not a short call synthetically because we have an outright short call here. John just said short put. Yes, this is exactly a position synthetically that is a short put. How so? Let's go to this right here. And think about it. If you have sold a put, if you just outright sold a put, okay, what you're banking on is for that stock not to go down to a certain level. And on the upside, your profit is capped to whatever the premium is that you have received for selling that put. Well, synthetically, if I own stock and I've sold a call, well, to the downside, selling that call only protects me so much, right? It protects me by that premium amount. If we get below that, just like if you get below a certain area when you sell a put, you're going to start losing. Okay? Does everybody see how this position right here, a covered call, would be a short put? So stock minus call. Awesome, Dave. Awesome. Okay. Let's get back. Last call here we're not finished. We are not finished, but last call for the Hulkster here. For Smash, get your name on the wheel, folks. Get your name on the wheel. I actually have a pile of goods to send out right now. So this one will be included when I make a trek to the post office today. Okay. What else? Well, here's some more advantages. Gives you flexibility to adjust your position due to market conditions. Okay, if you just own stock or if you've sold stock, your exposure is 1-to-1. Synthetics allow you to adjust that on the fly. Okay, arbitrage, market efficiency. Well, that market efficiency is going to be there because of put call parity. If you are ever looking at a scenario where a call and a put at the same strike with the same expiration, if the extrinsic value, not the price of the option, but if the premium or the extrinsic value is different, it's one of two things. Either there's a dividend that is in play, and we have to know that, or it is hard to borrow, which goes to the next advantage of using synthetic options, because in cases where a stock may be hard to borrow, and we've run into this before, you can use options to replicate a short position. Okay. All right. Any questions? The wheel is closed. I know this one was pretty in-depth today. But what I really, really want everybody to understand, and I'm happy to like follow up with a quiz for everybody at another time, understanding this equation right here, this simple equation leads you to be able to put on all of these positions here. Gilbert, we're not talking about spreads. So a long stock position would be owning a call and shorting a put. Same strike, same expiration. Let's look at a real example right now. Gilbert, give me a stock you want to look at. I'll bring in a option chain live right now. For sure, Paul. And we can talk about it more in the rooms too. But that's why I posted up the link here before, and I'll post it up again. So you all have the deck at your disposal. Gilbert, what stock you want me to look at here? Anybody? Just Microsoft. There we go. Microsoft's the first one. Okay, there we go. Here is Microsoft. Okay, let's go out to next week. The stock is trading 450.67 as we speak. Okay. Let's say you wanted to buy stock at 450. Okay, I know it's trading a little higher than that right now. Rather than going out and buying 100 shares and it costing you 45 grand-ish, you could buy that call and sell that put. Okay, and right now that's going to cost you about 40 cents to do that. Why is it going to cost you 40 cents to do that, to own stock at 450? Well, that's because the stock is trading higher than 450. Now, there also happens to be a dividend in play here, so this one's a little bit more confusing, but this is the gist of it. You could just buy this call, sell that put, and you have stock at 450. Okay? That will give you all of the Greeks, all of the P&L of owning stock at 450. So it's not a spread other than in the sense that you're long a call, short a put here. You're not buying a call spread, selling a put spread. They're outright options on both sides of the ledger. You can certainly adjust along the way and make a spread. At that point, you're not going to have the equivalent 1-to-1-to-1 ratio, and that's fine. Okay, we'll do one more here. Vic, you want to look at HIMS. Okay, HIMS is trading basically 62 bucks. Okay. Here you go. You could buy that call, sell that put. The reason that there is a, 17-cent difference or so is because the stock was higher than 62. But if you bought this call, sold that put for next week, that's the same thing as buying stock at 62. It works with any expiration, Gene. Now, let me throw a monkey wrench into this. Okay? Put call parity is based on a lot of things. The extrinsic value is based on a lot of things. Dividend, one of them, time to expiration, also interest rates. So the further you go out in time, the further you go out in time, especially with rates where they are now, a call option will always be more expensive than a put option, unless there's a dividend. That is factored into the Black-Scholes options trading model. Dave, we're not talking about what ifs here. All we're talking about is creating a position you may want. So I'm assuming with your comment about what if the stock crashes and you're in trouble with the put side, you're referencing having a synthetic long stock position, right? Is that what you were referencing? And I'll put up a real chart. Okay, great. Let's do it with HIMS on the screen here. Where is my drawing tool? Here it is. Okay, if you owned one call and you were short one put on the 62 line, there's your risk graph. That is the exact same thing as owning stock. And you can see that. Here's your delta. Your delta is 100. So sure, you have to worry about the put side on that, but if you own stock, that's like being short a put anyway. Right? And if you look at the P&Ls down here, the P&Ls replicate exactly what would happen to 100 shares of stock on the downside and on the upside. But if you wanted to do that, if you want to buy 100 shares of HIMS at 62, it's going to cost you $6,200. Here, you've got zero. You're going to have a little margin on that, but you've got zero. No outlay. It's going to cost you zero to replicate that position. All right, everybody. I highly, highly recommend, if you have interest, it's certainly up to you, review this discussion. I'm always happy to take extra questions in the room if you have questions on this as well. But it is that time to get to today's wheel. Ooh, it is definitely more filled up than it was yesterday. Okay, now remember, let me go back here and see who won. If you've already won this week, and yesterday was Kevin and John Titleist Pro V1, and Monday was Karen, I believe, and Randall. If you happen to come up again, we're going to pass you up. Here we go. Randall, are you there again? No, it's Troy or Mike. It's close. Mike do. Mike do. Pamela, what does clip do? I don't know what you're talking about. Clip. Mike Duke, are you in the house? Bingo. Okay. You know what to do. Shoot me an email. Swag size, mailing address. We'll get it out to you. Any thoughts and ideas for what you guys might want to talk about tomorrow? This is great that you guys are coming up with these suggestions here. At the bottom of the YouTube video, share a clip. Oh, you can share this. You can share this live stream with anybody you want. So right click on that. It's going to give you the link and you can drop it into an email or whoever you want to share that with. The clip means this recording. Strangles. Bingo. How about strangles and straddles, David? How about that? Does that work? Let me write that down. Tomorrow, strangles and straddles. Awesome. Great minds, right? They say that at times. Great minds. All right, everyone. As always, I really appreciate you guys. Subscribe, smash. Diagonals, I'll tell you what, we will do diagonals, James, on Friday. This is awesome, guys. So helpful when you guys suggest topics. That's awesome. So tomorrow, straddles and strangles. Friday, diagonals. Jake, it was great to see you last night with Howard. All right, everybody. Thank you again. I know we went long today, but that's okay. Have a wonderful day, and we will see you later. Bye-bye. If anybody missed it,